Hi, everybody. How's everyone doing? Good Fed week to everyone. We have the Fed on Wednesday. So with that happening, gold's popping here, looking for more liquidity, more opium. Hello, Mateo, Jugali, Tay, Shahab, Kevin, Brock, all my trading warrior brothers and sisters, Ren, Joswanth, Steve Vulgardis, I think I've heard of him before, Ingmar. So, this was a pretty good call from last week in the gold. I think there could be one more shot down here towards 1650. We'll see if that happens before or after the Fed. I wouldn't be short gold anymore. If we started trading back above 715, 720, then this correction is over. But when I look at RSI, still kind of tells me, especially on some of the short-term stuff, look at this low, the recent low we had on the 1 hour. It's a confirmed low, so you know what the implications are, right? Confirmed highs and lows, guys, after 3 years, I think most of you should know. And one thing that could set up one more low is, although US dollar yen is pulling back a little bit, right now it looks corrective. I really think you need a close in the yen back under 109 to get real negative on the yen. And it's all going to come down to yields, right? So yields had a pretty good week last week. TLT crashed pretty good. When rates are rising, the correlation is belong US dollar yen. So when I look at the yen here, to me, this looks corrective, and I'm going to be more interested in what the yen does up around the 110 level. Let's look at the weekly chart here. Yeah, I mean, it's stalled right here at a 200-day moving average. That's a weekly moving average there. It's a 200 week. So the day, yeah. So when you think about it, though, with the yen, with all the risk on we've had since the March bottom, this hasn't been that impressive, and it's happened with the weak dollar. So while this was happening, yields were climbing. See what's happening this morning. The only thing trading live right now are the 30-year, and maybe the 30-year has some problems up here about 180, 190. Greg is looking for one more shot down in the notes, which almost got back to a buck here. We'll see how much more is left, and then have one more final decline, see if it could take out the lows. And with that, I think that with this happening, if we get one more low, I have to believe it's going to be accompanied by some type of correction in the S&Ps and NASDAQ. NASDAQ hanging out above this previous record high that we had in March. So this is the way NASDAQ looks. We are not confirming this high. So this big red line goes back to the record high in March. So I think that would be your first warning sign of an impending correction, would be closing back under that. And then I've drawn, and that comes in around 97.30-ish. And then I have this wedge line drawn that I've anchored here at 84, which will be taken out around the 94 level if that happens. And then if that happens, you have to go back to the 100% retrace of this wedge, which is right around this moving average, around 8,400. I think 8,800 is pretty doable. Maybe the market holds together into the Fed. I think a lot of things are going to be waiting on the Fed, so maybe we have a couple of days of book squaring. Also think that we're in the process of topping in crude. It was an interesting open last night. We gapped open here last night, filled it fairly short order. have tried to rally, and we're back here at support, maybe 38.50 holds. I don't know if I could declare this a top yet. We still have some pretty good momentum here. I'd like to see it come off and then one more high with RSI under 70. And this was a TLT trade, pretty nice break. It took forever. So really it's all about yields. Maybe TLT could still push back down towards this 150 level, and there's a little left, but if the count is right for Grega, that's going to be a buying opportunity. And if there's going to be a bond rally, there should be a precious metal rally. And if there's a bond rally, there should be some type of yen top and sell off. And if there's going to be a bond rally, it doesn't always happen, but I think if we get one more rally to new highs, I think it will be accompanied by risk off in the S&Ps. Any questions on anything I've covered today so far? Is there anything else I really wanted to talk about? Okay, who's raising their hands? Okay. Are you asking your questions in chat or in the question box? I don't see anything in Q&A. So with that being said, guys, why don't you give us a shot here? Anyone do well on the short side of metals? You can if you have commodity kidneys like me, Andre. Okay. So with that being said, I'm going to bring Blake in and he'll cover the majors for you and tell you what he's looking at and see if the week ahead video is beginning to play out this week. But I think most major moves, if we have inflection points, most likely are going to be okay. Thanks, Jess. Just covered longs from down there. You still think it's vulnerable, Pete, for one more shot down? I hope you're not covering it. Okay, just because of my comment. Anyway, consider joining us. I'm going to have Joe or one of the guys put the link in. You could at least give a trial a shot for $1. You could, have all of our applications on your device. 1550. In fact, 1550 is pretty good target. It's going to be, if we do go to 1550, as you can see, it's going to be a real important level, probably could threaten the whole uptrend down here. So right now, I'm just looking at this RSI low, and there's always exceptions, but a 22 reading normally isn't the kind of compression needed to generate a big low. Okay, normally you need more compression where you have a low down here and then you have another price low, but the RSI is building a higher level. That might happen if we get one more break towards 1650. Okay, so those are my views. Those are my calls. The next one's yours. 800-899 bear. I'm just kidding. I don't have that phone number anymore. I used to get a lot of calls from Vermont, people calling, looking for Vermont teddy bear. I don't know if you've seen those, but yeah, I should have had a few to sell. Could have made a little additional revenue. Okay, 1550. All right. And I'm going to just toss it over to Blake and see what he's thinking here into a new week with the Fed. How are you today, Blake?
Good morning, Coach. How are you?
Good, buddy. How about yourself?
Good. It's kind of a slow open. Markets are pretty quiet. We continue to see this divergence, or actually, let me say, the shift from out of NASDAQ and this rotation out of NASDAQ into different markets. And we've been talking about that for the last couple of weeks. While you might see the NASDAQ underperform a little bit, start to see some of these other markets perform better. I think that's probably going to be a continued theme over the course of the next few weeks. That's not saying like, you might look at the NASDAQ here and go, wow, but we're at, all-time highs, and, some of the other markets aren't. But this is where all the other markets are starting to catch up, even though the NASDAQ is up right now. It's, you'll see that, that rotation, I think. But that's not, that doesn't have anything to do with obviously currencies this morning, Coach. But I heard you talking about the Vermont teddy bear. Well, I briefly heard you say something. What was that about?
You ever order those?
No.
You see the commercials?
Yes, I know exactly what those are.
My IB, my commodity IB, my number was 1-800-899-BEAR. So I got a lot of phone calls from people looking for Vermont teddy bears.
Oh, that's so funny. That's hilarious.
Yeah. So I never had any in stock, or I could have made an extra few bucks. There's a Valentine's bear and a Father's Day bear. And
oh yeah, I mean they have bears for everything. And they're big too.
Except for S&Ps, there were no S&P bears.
There's no S&P
they were selling.
All right. Okay. I was wondering what
the stuffing was torn out of them.
Got it. That's funny. All right. Well, as far as the markets go, Dale, it's actually pretty quiet, and I think I'd agree with what you had to say regarding being a central bank week where we have the Fed meeting on Wednesday. There might be some backfilling. You might see some position squaring ahead of that. And that brings us to like the euro. And on the week ahead video, I talked about the euro, pulling back, and this is actually the drawing that I made on the week ahead video. I just kind of left it on there, that we might get a pullback towards 111.50, and I think that's underway right now. What you'll notice here is we are challenging, this uptrend line in the euro dollar. Okay, and it's coming into play right now, but in order for us to continue to push lower in the euro dollar, we're going to have to see equities come under pressure, and I mean, that's been like a big ask. But you can see that this is a 24% retracement that we're challenging here, and it comes in around 112.65. So a break below this 112.65 might open a door for some further losses in the euro. There's a really big and important, in my opinion, big important trend line that just got tested in the euro dollar that should be noted. All right. So if you look at the euro dollar and go to the week, okay, this is a weekly chart. Now check this out. Okay. So if you're looking at a weekly chart and you just drop this trend line through the highs, we're basically testing that upper trend line, or did last week. And so this week it comes in about 113.60. And I'm gonna go with, for this week, at least for the first part of this week, we got to be defensive, and you have to be a little careful with the euro dollar while we're below, this is a 200-week moving average, but I'm not really paying attention to that. I'm really paying attention just to this downtrend line. So do I think the euro dollar overall is starting to turn higher, and it's trying to build a base to move higher? I do believe it is, but that doesn't mean we're going to go straight up. And we've had, we had, what's this, 7 or 8 days of just, massive gains going into the end of last week. We're seeing a little bit of a pullback, and so I wouldn't be surprised to get a pullback to the 38% retracement, which would be 111.84, or 111.87, and maybe even to 111.50. I think that's going to be a more logical place for us to get a pullback and be able to get a little bit of a pullback and maybe reestablish some more strategic and tactical longs down there, if given the opportunity. I mean, we may not even get that opportunity. I'm just trying to say that that we're probably, it looks like we're trying to pull back. We might have put in an intermediate top. And the question that you guys might ask me is, would I be on the short side of this? And it's really hard for me to be, counter trend the euro right now. I'd rather be on the long side of the euro. So, having um, having the euro pull back towards some sort of a support, that's going to be like the important thing for me to see versus just sitting here trying to chase it higher, because I did play the euro higher last week and did quite well with it. Now trying to play it up here, it's too overbought to be bought here, but it's too strong to be shorted. So I'd rather just, like I said, wait for a bit of a pullback. And you can see the cable starting to show a little bit of signs of weakness too. And we all we did was we came back and challenged the lows from the end of February. Now, some of the currencies that I think we should pay closer attention to are some of these commodity currencies like the Aussie, the Kiwi, and the Canadian. These are the ones that I think will signal a more or broader US dollar, bounce. You'd have to see it in the commodity currencies first. So, you've got the Aussie dollar, which, the Aussie dollar has just been extremely strong here. But, you want to see it come out of some sort of wedge, right? And look at the Aussie where we're at. We're within striking distance of the highs that were put in the very end of December, the 1st of January. I'd always thought that we were going to puncture that first before reversing, but I don't know. If the dollar can get a little bit of a foothold, it might be this might be it. And then we would be looking more at a very significant resistance in the Aussie dollar. One of the, I think, technical issues that most traders get into is that, they might look at the Aussie and say, well, that's a double top here. It's hitting resistance and we reversed. It's a double top. It's not a double top. That's actually just, pretty key resistance. But if we do reverse and then we break through a trend line, I'd be more apt to call it a double top. But for right now, this is just all very significant resistance as we pull into it. It's right around the 170.50 level. But you have to be a little careful with all of these currencies just because we are so close to resistance and support levels. Let's take a look at the Kiwi. Kiwi also has a, this is a wedge that it's developing. This is a ascending wedge. They tend to be reversal patterns, whether it reverses here or maybe it, ratchets up another, 10 or 15 pips. I think you need to be prepared for a possible reversal lower here in the Kiwi. But you can see that, very overbought. Oops, look at relative strength. These are levels that you typically just don't see, and when you do, you get a hard reversal from them. If you see all the relative strength down here, once you're at these levels, you are at high risk of a reversal, and that's going to be it's you see the cracks give way through some of these other currencies, like whether it's the Kiwi or whether it's the Aussie, maybe it's the Canadian. Now that we filled that gap, right? So you start seeing these reverse, that's when I think that you might see a little bit broader dollar strength against other pairs. And speaking of the Canadian, let's talk a little bit about the Canadian. We have now filled that gap at it was a 134.20. I think that was the 134.20 level. On Friday, I tried to play it on the long side a couple of times, and I think I flatted it or something like that. Nothing too exciting, but I still look at the dollar Canadian, and I think there's going to be a lot of support down here if we get one push lower. You can see that the daily RSI is pretty oversold. I wouldn't be surprised if we make another push to 133.50, but these levels are going to offer a lot of support because it was previous resistance as a big breakout point. And, I think you should look at currencies like this, whether it's the Aussie, whether it's the Kiwi, whether it's the Canadian, as opportunities, right? Let's see. Let's take a look at the dollar max. The dollar max, still at the 618 retracement. We were trying to get a foothold early or midweek last week. We couldn't make it back above 22. A couple people in our chat room are like, hey Blake, how do you feel about the Mexican peso? I'm like, as long as we're below 22, there's no reason to be on the long side. But if we get back above 22, that's where, in my opinion, the squeeze starts in the dollar max. But the question is, will we even make that? Well, as far as right now goes, we are staying below 22. So, you get back above this previous support, it'll act as current resistance. You get back above that, then we start to see a much bigger squeeze in the currency. I'm going to talk about one last cross, which is going to be the dollar yen. And then I want to talk about bonds really quick before I bring Steve in. So here's the dollar yen. Now the dollar yen has this big inverted head and shoulder pattern, which I believe it's still, going to play out towards 110 and quite possibly even higher. We did stall at the 618 retracement. If you are a ForexAnalytix subscriber and you saw the pattern in play get closed out on Friday at the 109.55 level, it's because we were at the 618 retracement post jobs report. It seemed logical that it would stop there. I do think it's going to find support on dips. Now, why do I believe the US dollar Japanese yen will find support on dips? If you guys are listening in right now, think about why the dollar yen might find some support on dips. Think about that for a second. I bet Coach would know the answer if he's listening in, but how about this? Look at the bond market. Okay, this is the 10-year. So the 10-year has broken down out of a wedge. You can look at Boons, same thing. We've been looking at the breakdown in Boons since that happened a week and a half ago. All right, since we've been down over here. But the breakdown in the 10-year has brought yields higher, and I think that the move higher in yields, across the curve, is going to help support the dollar yen. So does that mean that you buy the dollar yen here? I don't know if this is the place that you necessarily want to buy the dollar yen, but I think getting a decent pullback towards 109, maybe 109.15. I think these are going to be areas that offer opportunities for another move back up towards, the 110 level, and maybe even higher than that. So I guess one of the other things I should just mention really quick, and then I can bring in Steve for his opinion here, is regarding equities. You got equities that continue to be strong, and if you guys missed Drunken Miller's interview that was just on CNBC before this webinar, that was a really interesting interview. He was talking about some inner city school, programs that they've been working on, him and another gentleman. But he also talked about how he missed to be he missed, this massive rally. And I think that's the same with a lot of institutions. And that's why I think that the stock market continues to grind higher. Now, the question is, and this is something that we talked about last week, especially in the chat room, and is that, we are heading into an election season. And the thing is as Trump continues to lose support and we start to see that shift to Biden in the United States, that could have a pretty big impact on equities moving forward. And at some point, the market is going to start pricing that out. So when you look at the S&P, can the S&P go higher from here? Sure. I actually think that, with yields going higher, you've got, as you saw, the dollar yen that could strengthen even further. You got the NASDAQ that's breaking out into new highs. despite it being down a little bit today. You got the S&P breaking in new highs, or excuse me, in the NASDAQ, you got the Dow above the 78% retracement. We may be able to squeeze even further in equities before we turn lower. So I think that's important to keep in mind, because if that happens, those yen pairs, like the dollar yen, like the euro yen, like the Aussie yen, they should continue to squeeze higher as well, and alongside yield. So, this is a risk on, type of move all the way around. So with that being said, I'd love to hear what Steve has to say about equities at this point. Steve, good morning.
Good morning.
How are you? How are you doing? How was your weekend?
Good, fine.
Good. So, just having this conversation about equities and what we're seeing in the yen pairs and what we're seeing in the dollar right now. How do you feel about where we're currently at with equities at this point?
I think it's all sentiment driven. There is no question about it. And FOMO, the last part of this rally higher, has been driven probably exclusively by FOMO and people that feel like bad for missing out on this rally.
Yeah.
I think it's very dangerous because fundamentally speaking, valuations are the most excessive we've probably had in history. And in some cases, if it's not that the case, then it's the second highest valuations we've had in history. So, the path of least resistance remains higher given the fact that, this is not a market anymore. But I do think that on the way higher, there are going to be sharp moves to the downside, which is the usual thing that the market does to get rid of, all the weak hands. So, although from a psychology perspective, I think that a lot of people feel the pain of seeing this move and not being part of it. If you haven't been long already and, deep in the money, I think it's a huge mistake trying to buy, right here, right now. I mean, we are overdone, at least in the short term, in any type of metric somebody can find.
One of the things I don't know if you watched the Druckenmiller.
No, I didn't, but I saw that it was on, and I intend to do so later.
Yeah, he one of the things that he said that was interesting, because he was talking about his their initiative that they got going on, and he, of course, at the very end, he's asked, hey, you were on, a month ago, and things look a lot better. How do you feel? He's like, he basically say, I've been humbled by this market. It's not the first time nor the last time, and we all have. But what he did point out, which I found was very interesting, and it kind of goes along with what I was talking about on the week ahead video, is that he said his growth weighting is at the lowest it's been in 6 or 7 years. Now, when you think about like the market, and this is the S&P here, and I talked about it over this weekend about the V-shaped recovery versus the swoosh. You get a V-shape, right, versus a swoosh, which would be a longer term, just grind up in the market. And we're basically, in my opinion, we're just completing a V-shaped, recovery technically, and then we're going to be sideways dead market probably for a long time, and which is great. In my opinion, it's awesome. From a trading perspective, I'd rather have done that. I'd rather do what we're doing right now than having 3 or 4 years of just grinding higher, like we saw, post financial crisis, because the opportunities from a volatility standpoint are very little when you have just a grind in one direction or the other in the market. So, like, let's say, and I'm just forward looking the S&P really quick, and just imagine 2022 is pretty realistic. So let's just say that the market, we get this V-shaped recovery, and then the market does this for the next. Yeah, I can actually draw that out a little bit better. Let's say we're in this type of range. Oops, we're in this type of range for the next several years. Rally towards the highs, pull back. People get really bullish because there's a vaccine or whatever it is. Then people start looking at the growth scare and blah, blah, blah. Then liquidity factors and, yada, yada, yada. And we're bouncing around between, 27, 2,800 and 3,200. in the S&P. I think that's very realistic moving forward as we work off all this excess, capacity. Now, what does that mean, for us as traders? That means there's going to be a lot of opportunities. And like I said, I think this is way better, in my opinion, than having a multi-year grinding higher where you just don't get any opportunities for pullbacks nor volatility. So that's what I think is going to be happening. And I think that when you take into account Druckenmiller's comments about growth weighting, I think he's spot on. He may have missed a lot of this rally, and I think a lot of people did, but I think that the COVID issue, it's a longer term issue. And I just happened to be listening to CNBC this morning, which I don't normally do. And you think about like theme parks and and travel and yeah, it's going to be a drag on the economy globally for quite some time. That's before we
It is, but does it matter in the short to medium term? Not really.
Not really, but in the
markets
longer term,
the stock markets have completely decoupled from economic reality, completely. So
I think in the immediate term it will, Steve. Have you watched the protests in the U.S.?
Yeah, plenty.
All right,
of them.
do you see thousands of people out there half wearing masks, half not wearing masks?
Oh yeah, absolutely.
Okay, so doesn't that make the likelihood of a second wave even more possible this fall?
It does.
And what happened with the first wave? I'm sure many governments are going to be more hesitant to shut down, but
they won't. I'll tell you in advance.
They won't shut down no matter what.
No, they won't.
Okay, well, we could have anywhere from 2 to 10 times the magnitude of the first wave in the second wave, from if it plays out like H1N1, like that piece I sent you by Jim. That's only a double. But in 1917, the magnitude was much more than twice as much. I don't even want to tell everyone what it is, but it was, the worst one. And where basically the same behavior is happening socially. 100 years ago, we won the war. We celebrated Armistice Day. The flu season was over, and everyone went out and had their state fairs. And instead of state fairs, we're having, tens of thousands of people out there, not social distancing, protesting. Just wanted to say it could be a factor in the push back on the medium term here. This
could
fall,
be a factor.
I'm concerned.
There's no question about it. But after what we've seen now, what makes you think that even a temporary shutdown is going to be greeted by a sell-off in the markets? I mean, I bet you that if it happens again immediately, you're going to see a sell-off much shallower than the first one, because everybody's going to be smart, thinking, okay, what happened the previous time? They threw a lot of money in the market, and we got a V-shaped recovery. So I'm going to, front run this because I know they're going to do the same. No, there's no question about how this is going to end.
May not work.
There's no question about how this is going to end. It's going to end in tears. And everybody that will have assumed they're like a rocket scientist for, making money on the long side, buying things that make absolutely no sense in valuations that are completely absurd, and companies that are zombie companies rallying like, massively every day, but it is what it is. I mean, everybody's going to be smart doing that until the day they're not, and they're going to lose everything.
I think a second body blow, and I'll go with Jerome Powell on this one. He's very concerned about a second wave and doesn't think monetary policy would solve that. So, 2 body blows in a year, I think, would be a surprise. No one's looking for it. No one,
guys,
don't you think? Go ahead, Split.
Hey, while you debate this, I'm going to turn it over to Steve. But I want to say, for those of you that are supporting ForexAnalytix, thank you. I appreciate it. We all do.
Yeah.
For those of you that haven't tried out ForexAnalytix, remember it's only $1 for 10 days to try it out. Make sure you download the mobile app when you're trying it out, and you'll be trying the premium version anyway. So we'll see you We'll see you soon. And Steve, I'll pass it over to you so you can show some of the charts.
Okay, Blake here.
Yeah.
About
Thanks
Bye-bye,
for
mate.
stopping the argument, Blake.
All right. Thanks,
All
guys.
right, buddy. Good luck today. Peace. Blessed be the peacemakers. So anyway, Steve, I'm through arguing with you. Go ahead.
Oh no, it's not that we
No,
have
I'm
any
kidding.
real disagreement. I'm just telling you that this market is so absurd that nothing would really surprise me
All right.
as a reaction. Because, you know, when you are in the sphere of illogical and paranormal, you know, how can you judge what is more paranormal than the paranormal things that's happening? It's like, you know, a guess game. You know what I mean?
Yeah. Well,
You
know,
yeah.
I was just giving you Rod Serling's analysis of the S&Ps for this fall. You know who he is, right? Rod Serling.
Yeah, absolutely.
You ever see his charts?
I think that we're gonna. I think that the drama is not over for sure, and I think volatility is here to stay. Testament to that is the fact that, for example, the Nasdaq is at all-time highs. The S&P is getting almost there. The VIX is stubbornly holding at this 25 support area.
Yeah, so that's changed. We have a new volatility regime. We'll never see 10, 12 again.
Yeah, and the next big move in the VIX, trust me about that, is not going to be to the downside. Even if it's a short-term spike,
50?
might be a short-term spike, but I think we can easily spike to 40 to 50. Yeah, absolutely.
Yeah,
we can
like
easily
a retracement.
Yeah, 40 to 50, it's easily doable.
Yeah.
Now, having to do with, you know, the structure here, you can see, I mean, I don't know if you saw all the reports about, you know, the unemployment numbers.
Oh, yeah. Yeah.
Yeah, that's another joke there.
Yeah.
But it doesn't really matter. I mean, nothing really matters. I still believe that we're very overdone here, and I think that, you know, we should see a sharp correction lower now. You know, equality of wave 5 to wave 1 comes at 32.26. We had discussed this with Gregor when he was here. We're very, very close to that level now, just 15 handles away. You know, you just have to be looking one resistance area after the other. I don't think that the S&P is going to be printing a new high before we see this correction. I think it's extremely hard. And I think the scenario was talking about a new all-time high in the Nasdaq, while the S&P does not follow through with that, at least initially, is playing out as we speak. So we might see this divergence playing out. You know, I'm still short here, and I'm still expecting a pullback. Now, you know, depending on the nature of the pullback, I might actually buy it. I mean, I was long the S&P from like 420 to 28.55.
Yeah.
And I'll have no problem being long again once we see a pullback. Now, given my target was a lot lower, but, you know, given the extended nature higher, you know, I have to tell you that, you know, my first target will now be roughly at this area, 29.70, you know, given the fact that we've already moved, you know, substantially higher. But I still think there is a very high probability that we're going to see a deeper correction than that. We're going to move below 2800. But, you know, it's just a waiting game. I mean, it's being patient that matters here. Nasdaq is still perfectly following this ascending wedges formation. Now, given the fact that this is a very vertical ascending wedge, I think that the chances that, you know, the Nasdaq is going to blow off above it are very, very, very limited. I mean, if it was a lot less steeper, that could have easily been a bullish formation. But given the fact that it's rather steep, I think that it is a terminal formation, and it should retrace back to the beginning of the wedge, meaning back towards 8,350. Now, no need to keep talking about the indices because nothing has really changed. I mean, we've been grinding higher, but you know, my opinion of what's happening here is not really changed. What I can say though is that we know which pairs are correlated, highly correlated with risk. And for example, we see that the Aussie is clearly continuing to the upside, but you can see from the last 4 candles that there is, you know, definitely some momentum loss here, right? And indecision. We had a spinning top, another spinning top, a pin bar. Today, so far, an inside day. So, we're seeing all this hesitation as we're testing the previous high just above the 70-cent area. It will be important to develop a higher high because that's an important part of a longer-term shift higher. And I think that we might not do so yet. I think that this is a pair that needs at least a decent pullback. More or less the same applies here in the Kiwi, monitoring this ascending channel. So I do think that all of those instruments should be producing a pullback, and until they do, I don't care how much people are like worried that they're missing out, but I'm not going to change the fact that I consider it stupidity to chase them, and there's absolutely no chance I'm going to be chasing them. And I'm okay not participating in that. I'm participating in other stuff. So I'm still short the USD NOK and Euro NOK, which are doing excellently. I'm out of the money in the S&P, but at least I had built a cushion by being long for so long. And I'm going to be fine by even reversing those positions once I see there are signs out there.
Are you there,
Now,
Steve? Oh, okay.
Yeah, sorry.
All right.
Just
Crude is rolling over. What do you think?
Listen, having to do with crude, here's what I'm monitoring here in crude. I'm not surprised that it's going to try to roll over from here. Why? Because I said it on Friday again. I have been monitoring this steep ascending channel, and I don't think for crude it's going to be easy to go over it, unfortunately for me. Because I would want to, for personal reasons, I would want for crude to stay strong for another 4 days because I own several Total stocks. I'm deep in the money, but I can't get rid of them until next Monday, because there is a cool-off period which I can't sell them back to the market. I do think, though, that we might see a pullback from here, or at least, at the very least, a consolidation period. It's overbought. It's already taking people to the woodshed, people that believe that we're going to see lower levels. I warned since the very beginning here when we saw this up move that I think that we've probably seen the low in crude. This is a continuous, by the way. That's why you don't see any negative prints. In the continuous, the lowest we went is $11.1. This move is definitely overdone in the short term, but I do think that this 29.30 support resistance area can act as support and produce more strength in the crude market. But crude also nicely correlated with risk. I do think that it's due for a pullback, and I do think we're going to see it rather soon. Now, having to do with crude, I'm more convinced than I would be for stocks that any decent pullback is going to be a buying opportunity. I still think that we're going to see much higher levels in crude. We haven't even seen the beginning of dollar weakness, and one of the main reasons why I'm bullish crude is because I'm very bearish in the long term the dollar. And since we're talking about crude, denominated in dollars, that's one thing to consider. Now, another instrument that is likely to reverse, at least for a pullback from here, other than crude, is copper. Where are you? There you are. Copper. So copper, once again, tested it on Friday. Once again today, testing this confluence of resistances at 256. Horizontal support resistance area, 200 daily moving average. Also very, very close now to this ascending channel trend line resistance. So any way you look at it, I wouldn't be buying copper here. I mean, this is, if you want to trade it, you trade it to the short side from here. You don't buy it up here. Now, same deal with Aussie. And keep in mind that, Aussie and copper are, very decently correlated historically as well. I mean, I don't need to do much to prove that to you. As you see, the Aussie has overperformed lately, but in general, let me zoom out a little bit so you can see it. So you can see that, sometimes the extent varies a little bit. So for example, the Aussie overshot to the downside in this case at the low. It has now overshot to the upside. But you can see the correlation here, right? It's very, very tight. very frequently you can use these instruments to also time a reversal for the other one. So for example, let's assume that you see like a sharp reversal in the Aussie and the copper hasn't responded lower yet. I mean, let's say you have copper on resistance, you see the Aussie reversing and the copper not doing much. You know, probably it's a good opportunity to short copper for a late reaction to the reversal lower from the Aussie, or vice versa, right? You know, another instrument that I think is very vulnerable to a possible sharp pullback from current levels. Other instruments that look like they might be reversing are USD NOK. So USD NOK testing a little bit of an overthrow this horizontal support resistance area and a little bit of an overthrow to this descending channel. Keep in mind that, just count this, 2, 4, 6, 8, 10. So far today, the 10th consecutive down day in USD NOK. Significant support resistance area here, you can see. Very overdone. I'm still short, by the way, right? I'm very deep in the money here, and I don't intend actually to get rid of this position because it's 1/3 of a position I'm actually going to be looking to add, you know, in case we do something like this, right? Same with Euro NOK. Another one is USD SEK. So USD SEK testing these channels, support, some horizontal support areas as well. You can see roughly here. So I think overdue for some type of a pullback, even a short-term rebound. USD CAD. Here it is. So USD CAD below the 200 daily moving average. I'm betting that this might actually trick a lot of people. Next downside area of support at 133.20, but I do think that, you know, the risk-reward ratio has greatly shifted to the upside. So, you know, I'm not ruling out a little bit more weakness first. I was expecting that perhaps we might see a reaction from here, but I'm not going to be surprised even if we, you know, move a little bit lower. But I do think that USD CAD is going to see a sharp rebound rather soon. So, you know, bottom line, don't go chasing after any of those. Because I do think that, you know, you'll find yourself entering the market at very, very bad levels. Now, I'm not ruling out that the reactions in all those pairs might prove to be corrective, but even a correction can be very sharp and can produce like a, you know, a rally or a move lower, depends on, you know, which direction they were moving. That's several hundred bips, and I know that, you know, by monitoring, you know, your comments, etc., I know that many of you, you know, are not trading like with, you know, medium-term horizons and, you know, wide stop losses. So I don't think it's a smart idea trying to chase all of those. Now another pair that is looking like it might start, I might be starting a corrective move is Euro Yen. Depends on how we close today. So we do have, you know, many of the elements of an evening star formation here. I would want to see, you know, a push lower though before we close the day to look for something like that. Now, in this case, I do think that this move higher was quite impulsive. So I think that, you know, there's a big chance that the move lower is going to be corrective and it should be bought. But I definitely don't think you should be chasing, especially, you know, if the daily close today is quite bearish. Euro USD, Blake mentioned it already showing a dark cloud cover on Friday. You know, might be the beginning of a pullback towards like 111.50, 111.60. Can even take us down to 110.60 something. But I do think you'd probably be seeing buyers step in the market if that happens. So, you know, don't chase it up here. But on the other hand, I do think that probably buying it a little bit lower, you know, until proven otherwise, is the way to go. Now, let me go through some of your questions and we take it from there. Okay, let me see. Nifty and natural gas. Yeah, we're going to have a look. Euro INR. Hi, Steve. If euro is a major contributor in DXY, it is 58%, 57, 58, one of the two. And it's appreciating to higher levels. Why DXY is going so down? Second thought, when yen is doing such badly against all currencies, is it only because risk on or fundamentally something has changed with the JPY? Listen, traditionally, yes, the yen is one of the ultimate, the ultimate risk of currencies are the Swiss franc and the yen. That's why I'm a little bit skeptical about the yen up here, because I do think that we're going to see, some type of a rebound. Some type of a reversal in risk. So I think we might see a rebound in yen. So, a move lower in USD yen. Also, consider me exceptionally skeptical, given the fact, as I've said in the past, that USD yen has already produced 3 sharp false breakouts from this symmetrical triangle, to the upside, to the downside, to the upside. So, consider me, very, very skeptical about trying to chase USD yen in any direction. Because somebody can say, yeah, but this way it's more or less guaranteed that you're going to miss out on the real breakout when that happens. Answer, yeah, I'm absolutely fine with that, because you know what? I also missed out on the fake breakout here, the fake breakdown there, the fake break up here. So, if it is for me to miss a genuine breakout and having also missed 3 false breakouts that would have lost me money, count me on board with that possibility. I'd rather lose 3 losing opportunities than anything else. So as long as the situation is what it is at the moment here, which is I have a currency pair that is not really trading normally in any way you look at it, I'd rather just completely miss out on it than let it chop up my account.
Steve, you know what? I don't have FOMO. You know why? Because I miss trades every day. So if it drove me crazy, I'd really, probably would have a nervous breakdown because of all the trades I miss every day.
Statistically speaking, we're going to be missing more trades than taking, right?
That's right. And so,
that applies to everybody. Even short-term traders.
Yeah. Can't worry about missing a trade.
No, it's really it's a
even
psychological
bringing up
trap.
The question tells me that person has to take a look at himself and say to himself, I miss trades every day. That's okay, because there's always another one around the corner. Take the pressure off.
There isn't, and at the end of the day, it doesn't matter how many trades you miss or how many trades
FX psychiatric bill will be mailed today.
It doesn't matter how many trades you miss and how many trades you take, because at the end of the day, it just matters,
if you're making money.
Do you have a positive P&L? And if you do have a positive P&L, the rest are details. Yes, you can fine-tune how you can make your positive P&L more positive, but keep in mind that the vast majority of people don't get a positive P&L. So you start by getting a positive P&L, and then you can fine-tune, your approach and your market tactics, so you can have an even more positive P&L. One thing is for sure, I haven't never really seen people that go psychotic in chasing moves that they've missed that actually make any profit. So if that tells you anything.
Got some help.
Yeah. Now, having to do with the fate of the dollar index.
The fate.
Yeah. Listen.
So dramatic. Oh,
yeah,
God.
The situation is quite equivalent here. Let's zoom out. I don't really see a trend here. Do you? No. I'm still of the opinion that there is a chance that this market is going to fake everybody out and produce another high. Although I'm extremely bearish the dollar, I think that this move lower in the dollar might not play out yet. But in any case, in order for us to discuss even any possibility of bearishness, at least we need to see a lower low. And a lower low in this case would mean a move below 94.65. In any case, first area of resistance is 97.70. So we found support in this confluence of supports at 96.30, and okay, I understand somebody wants to short this move because they think it's going lower. You can do that at 97.70, but don't do it here. Don't do it now. At least wait for this small rebound towards 97.70. But keep in mind that this move can still be interpreted as a corrective move. Even if we retest the previous low, it can still be interpreted as a corrective move. So, hold your horses here and, don't jump the gun just yet. Trust me, and you need to trust me in that. When the dollar turns lower, there's going to be so much money to be made being short the dollar that if you've lost the first 10%, it's going to be absolutely okay. Because I think that once dollar really turns lower, it's not going to stop until it depreciates for at least 30%. 25 to 30% easily. How do you see Fed curve control affecting the US dollar? Seeing now it's possible with cheap long end and effects of bear steepening for future inflation. If I understand correctly, will it increase the value of the US dollar? Absolutely no way. Monetary policy that's being followed at the moment is going to be extremely corrosive for the US dollar, but these forces are not going to play out immediately because these fundamental forces need some time to to manifest. So there is no possible interpretation of what's happening at the moment that can be interpreted as a dollar positive policy. Neither of the policies being followed at the moment. But as you've seen many times, that doesn't mean that those policies will have their effect on the dollar, which is definitely corrosive, as I said, play out ASAP. USDTRY, we have a question. Let me go to some exotics because we had questions. So USDTRY has already taken a leg down. Can easily produce another leg lower. So far, I'm seeing a consolidation here. So I do think we might see, another lower low. But keep in mind that in general, the USDTRY has been one of the most battered down. The TRY has been one of the most battered down currencies, and for a good reason. So in general, you need to be very careful whenever you're long the Turkish lira. Very careful, and you need to make sure you have a specific risk reward in your mind. There is a positive. You're getting paid decently to hold Turkish liras, but keep in mind that a lot of people were of the same opinion in the past, and of course they ended up losing due to the depreciation a lot more money than they were making by just holding the currency. So in the short term, it looks like it can have another leg lower. So probably not a bad area in general to be still short the USDTRY. But in general, keep your targets, objective. Don't try to envision like all-time highs necessarily and think that we can move from like 720 to 4 just because we've had at least this multi-year, actually it's 13 years or whatever that this pair is moving higher non-stop. So take it one step at a time. But as I said, for the time being, it looks like we might have more weakness in the USDTRY, and it pays to be short. So natural gas, question about natural gas. Listen, natural gas remains more or less without a trend. Let me find it and you'll see what I mean. Here it is. So it remains without a trend because although it found lows and it started diverging long before crude bottomed out, it's been trapped in this rectangle, right? You can see that this range from $1.50 to roughly $2 is a range the market has been respecting since the first days of the year. So it's almost 6 months now that the market has been oscillating in this $0.50 range, right? Not that $0.50 is a very small range, given the fact that it's, you know, between $1.50 and $2. So from a percentage perspective, it's not like very little, but it's still like a rectangle, right? I'm still inclined to believe that eventually it's going to break out to the upside, and it's going to produce a lot more upside, you know, following a legitimate break above $2. But we're not near that. So, you know, the only thing you can do as long as we're trading in this range is trade the range. So whenever we get close to support, you can buy it. Whenever we get close to resistance, you can sell it until you actually see a breakout. Personally, an honest opinion, I would not be following a breakout to the downside. So I would be following a breakout to the upside, but not one to the downside, because I think that the breakdown to the downside is going to be limited and very short-lived. But I would be following a breakout to the upside because I think it can really extend much higher. USD INR, we had a question about it. Listen, I still see a triangle here. I said it a long time ago that this is likely a triangle, and the more we spend oscillating here, the higher the chances that that's the case. And the implications of this being a triangle is that there is a higher probability of seeing another push higher before lower than just breaking down to the downside. Okay, so here's your triangle, and so you know exactly what you need to be trading here. And you had a question about the Nifty as well. Oh, was that a sound signal for me? Sorry, I could barely hear it. Okay. Okay, finishing up with the Nifty then. Nifty, if you remember, I talked about the Nifty when we were, you know, somewhere there, and I said there are two probabilities. One, we break down directly from there and we head lower. Second one, this is a corrective move, another leg higher towards the 61.8 and then lower. As you see, we're very close in fulfilling that, you know, latter assumption. So I think that the risk reward has greatly shifted to the short side from here. So, you know, do what you wish with that, but, you know, I would be very, very careful the closer we get to this 61.8, also horizontal resistance area. Okay, Dale, who do we have for an interview today?
Andrew Pancholi, and
Okay.
a very well-known cycle guy, and Andy's prepared so a PowerPoint with his cycle work. I'm really looking forward to it. I've worked hard to get Andy to finally come on the show.
Perfect.
And unless you guys would rather hear Stairway to Heaven by Zeppelin, what do you think, Andy or Zeppelin? I'm going with Andy here.
I'm going with Andy as well. No offense.
I don't blame you, man. My guitar skills aren't that great. Anyway, all right. So Andy wanted to hear Led Zeppelin. All right. So let me get you set up now, Andy. There you did it.
Can you hear me now?
Got you, Andy. How are you?
Great. It's very kind of you to have me on your show, Dale. It's nice to be here. Weather's pretty cold here in England today, but how?
Andy, let me just, I didn't have you set up as a panelist. Now you could, now you should be able to talk. There we go. Okay. Well, you know, I believe it was
Dale.
Chris Carolyn mentioned you in my last interview with him.
Dale,
you guys share? Huh?
Why don't we get him set up with his screen as well?
Yeah.
Because I have to jump on a meeting to make sure that everything's okay before I go.
So, Andy, there's a green button, share screen, drop-down menu.
I just need you. It's just stopping me from sharing screen. Right. Okay, we have it now.
Now you got it.
We've got it now, and I'm just going to try and get this PowerPoint.
It's coming up.
Perfect.
Thank you, Steve.
Thank you. Enjoy.
Okay, and we see your PowerPoint up there, Andy.
How about that? Do you see that, folks?
Yeah, we've got it. And, you know, I just want to make a quick introduction. Andy is the author of the Market Timing Report and 0 Hour. I'd like to hear about 0 Hour. And he's also a board member for the Foundation for the Study of Cycles in GAN. And gosh, I remember that being around a long time ago during days like Peter Eliades and who were the founders again of that that foundation.
Right. Well, yeah, we just reformed. The foundation went through a bit of a quiet period. It was originally founded by Edward Dewey back in the 1940s.
Oh, okay. Dewey.
Yeah, and the idea was to see if if the depression could have been prevented if they discovered any cycles. And of course, we're just going through the same thing right now, 90 years on, and that's one of the things I'm going to talk to you about. But yeah, we've seen Peter Eliades is actually going to be doing a presentation for us. We're going to have our summit on the 22nd of July for a few days. Sorry, on the 22nd of June. It's a non-profit. Everybody's turning up for free. We got some big names: Jake Bernstein, Peter Eliades, Bill Sarubi, Richard Smith, McClellan, Sherman McClellan, Hirsch. A lot of big names. So
yeah, you're missing one.
Yeah, Larry Williams as well. So
yeah, you're missing one though.
We're missing you, sir.
Yeah, that's right, Pinkert. Well-known lunatic, Andy. All right. So anyway, I don't want to take up any more time. I want you to go right to your work. A lot of people have a hard time wrapping their head around W.D. Gann's work. So I really respect people that I know it takes a lot of time, a lot of study to be able to implement his strategies if you can uncover them and use a Gann wheel. And I'm interested on your approach of cycles. So I'm going to shut up now, Andy.
Okay, Dale. Well, what we'll do is, as it's the first time you very kindly had me on the show, I'm just going to give you guys an overview of these bigger cycles and see how they came together and how we were able to anticipate this crash. And we mentioned 0 Hour, the name of the book we wrote a couple of years ago, forecasting this, and that's exactly where we're at. But let me build it up for you. And folks, I know a lot of you are primarily sort of short-term or intraday traders, but I hope you find this pretty interesting. And there's a lot of information here. So I genuinely believe that we're in the most critical time period of our generation, if not this century. And I think this is, what we're seeing is a once-in-a-lifetime event. Just a quick note, if I disappear, Dale, I'll be back in 2 minutes. We're having internet outages here in England, and it's not because I'm just going off to listen to a few riffs of Stairway to Heaven.
Okay, buddy.
And much as that is one of my all-time top 5. Right. It's an educational webinar, so we've got to say that sitting here in England. But what I am going to say, and if you stay with this, and I hope you do, by the end of this, you will know how to forecast the big market crises. I'll show you some of the trading techniques I use. I know a lot of you are very experienced traders, so I'll apologize right now because I'm sure you got much better stuff than we have. But anyway, here's 30 years of my work. And most of the world feels that markets are random and events are random and you can't time them. A lot of them are driven by fundamental news and therefore they can't be predicted. But I beg to differ. And let me just go into this a bit more detail. And really, in order to master market and business cycles, we look back at history. And here, this is where it gets cool. You get to see some mathematical order. And markets and history repeat in the same way as human behavioral cycles repeat. So let's give you a quick, let's give you a teaser, right? So I want to show you, this is what we're going to lead up to, and we'll look at what's going on with I was listening to Steve there talking about the dollar index. I have some interesting stuff on that towards the back end of this. But here's a macro forecasting system. This is what we've developed. And what I want to show you is where you see these spikes in the market, these are predictive. So we get these ahead of time. They're not volume. And this is what we've created from our modeling system here. And we get future spikes showing where future turns are likely to be. And, you can mark these in your diary. We'll revisit this slide a bit later. But late, this year, October 2020, we're seeing a cycle. That's going to be a potential reversal. Mid-January 2021 and late November 2021. There's just 3 points there that I want to share with you already. And you can see we had a big spike warning there back in February. So this is part of our predictive system. And I'm going to show you a lot more about that.
Could I just interject one question? Do you, beforehand, Andy, have a bias as to whether these turning points are going to be highs or lows, or do you have to wait for near that time period and just know that it's an inflection point, but at this time you don't know what
Right.
it will be, a high or a low.
Great question, Dale. Basically in the old days, I would have a view on it, and then I'd usually be wrong. So,
Yeah.
So what we say, these inflection points that we're looking at, I'll just bring that slide back up. These spikes, we know to expect something, and 90 to 95% of the time, the reversals. Every now and then we get an acceleration, and actually, on the daily cycles, we did see an acceleration on Friday with the non-farms and everything. So, and what we do, and I'll talk a bit more about this, is we combine it with other techniques like commitment of traders data and seasonality.
Okay. All right.
That's a great question though, Dale. But just in case you've got any followers who are non-believers of cycles, goodness gracious, in case any
Not mine.
So just in case, let me ease you guys in gently. And you might be familiar with the years of the decade. And what we're basically saying is there's a guy called Edgar Lawrence Smith who wrote a book in 1939. And sorry, I'm going to go back in history. I'm kind of apologizing, but I'm not sorry that I'm apologizing. Stay with it. It'll be worth your while. This guy in 1939 wrote a book examining the years of the Dow, and he only had 45 years of data at this point. And he found that years ending in 3, 7, and 0, or 10, and sometimes 6 were up and down years. And don't worry, I'll show you a chart in a minute. And years ending in 5, 8, and 9 are the most bullish years. And his research said this was down to weather, sunspots, radiation, and all this affects optimism and pessimism on humans. And here it is in visual form. So what we're saying is year ending in 0, certainly if we looked at February, March, April this year, we had a big down. I'm not convinced this whole thing's over yet. These two are the more bearish years of the decade. Years ending in 7, pretty much every year ending in 7, apart from 2017 and the last 100 years has been bearish. But also, you can see years ending in 5 have a big up move as well. And of course, years ending in 8 and 9, that was the big run up we had on the S&P and the indices back into the beginning of this year. So
and the 2008 and 9.
Yeah.
And the 1999 top.
Absolutely.
Just thought I'd reinforce it.
No, absolutely. And actually, whilst we're doing that, so we took this, people are familiar with the 10-year cycle. I did a bit of research in the 100-year cycle, and you'll see that coming up. But the last 5 years of every century have had 5-year bull markets. So from 1795 to 1800, 1895 to 1900, and 1995 to 2000. If you want to be running for president, you want to get your great grandkids to run for president the last term of the century, they're going to be sitting on a great bull market. So that's
interesting.
That. Yeah. But now you might not be so familiar with this. The real secret is in the super long-term cycles, and it's about knowing where to look. And what I've been doing here with my team is we created all these crises matrices, and we put down every historical event. And we have a bunch of these, and we can see patterns unfolding, and that's how we kind of hone this down. And if any of you have seen the market timing report, you can see how we do the geopolitical prediction as well. But let me start off with the 72-year cycle. And, why the 72-year cycle? Well, you've all heard of the 1929 crash. If we add 72 years to 1929, that takes us to 2001. And, the market's topped out in 2000. So pretty close, give it a year, give it a few weeks and months. But we got this pretty clear cycle. And you got to look at the broad brush cycles, and I'll show you how we fine tune it then. But, if you were sitting in 1929 and, Gann predicted this, and I think he did this on the basis that if you go back 72 years from 1929, you get to the 1857 panic, which was huge. And we'll look at that in a moment. But both Britain and Europe, as well as America, had big financial panics. So for those of you, this is like being common news now. We were showing people this over the last few years, forewarning them. But, most people will be familiar with this chart now where the Dow came, made a high at 386 back there on the 3rd of September, 1929, and came down 90%. 1857, very few people know about this, but the market came down 62%. So, basically made a Fibonacci retracement there, pullback. And this was basically due to a whole series of things, basically the railroad boom had bust at that point as well.
And it rallied all the way through the Civil War. Interesting.
So That's right. Yeah, actually, there we go. Pretty strong. Well, yeah. So the Civil War started here, didn't it? And it rallied all the way up through there. And actually, I will tell you why in a minute. So
Okay.
I hadn't thought of that like that. I was going to talk about that in context of commodities, but Dale, that's a great point.
Yeah.
Let's just move to 2000 to 2001, and the market started running out of energy. We saw the end of the tech boom there, and what we saw was that they came down 40% really as we headed into the new millennium there. And that's effectively the 72-year cycle kicking in. So, if you're paying attention and you want to write this down for your grandkids, 2073, that's 2001 plus 72 years. That's the next one. And I kid you not, that is going to be like clockwork. So make a note of that one. Now, we double up the 72-year cycle and we get 144 years. And let's take a look at this. And you hit it right on the nail there with the Civil War. But let's go back 300 years to, from now to the South Sea bubble in 1720. So this is a boom and bust. At the same time, we had the Mississippi land crisis. And if you guys have ever studied this, a guy called John Law, who was a Scotsman, went over to France, convinced them they should unpeg their currency from the gold standard. He made it available to everybody, and he started selling people swampland down in the Mississippi and, New Orleans. Basically, that was a boom and bust. So there were two big boom and busts 300 years ago this year. We'll come back to that one. Add 144 years, Dale, and we get to 1864. We see, we're now well into the Civil War, and we see a huge commodity boom. The price of cotton was trading at 3 cents a pound as we ran into the Civil War. But by the 23rd of August, 1864, cotton was trading at $1.69. So it had gone up, $1.89. It had gone up almost 60-fold. And Gann wrote that on some of his charts. So that's where we picked that up from. So it was a 60-fold increase. Why? Quite simply, because it was demand and supply. Suddenly, there's nobody left tilling the soils, creating cotton. Right. Everybody's out fighting the war. And what do you need to fight a war? You got to look smart. You got to have a uniform. So the demand for cotton goes right up. Supply goes down, and everything goes up 60-fold. And it wasn't just cotton. Wheat made huge. You can look at Gann's old charts. You're obviously familiar, and several of your readers, followers are. Your listeners are. But wheat had a big boom around about then as well. And I think it's probably this commodity boom that answers the point you made, that the stock market went all the way up through that time, Dale.
Yeah, okay.
So now let's add another 144 years. And this was the commodity boom that we saw in 2008. And it was the first of a couple of, we got a double top 2 years later, as it were. More than a double top, we got a secondary high. And this was due to partly the dollar being weak. I mean, I remember, happy days for us Brits, $2.11 to the pound, Yeah,
I remember.
Yeah. I was spending all my time in America. In fact, actually, as it happened, I spent so much time in America, I ended up marrying an American the next year. So that was
congratulations.
She's over here now. So anyway, that's the 144-year cycle. And really, I know this is a long way ahead, but, we talked about 2073. 2080 will be, the half cycle adding 72. And then you can put this one down for your great-great-grandkids. But this is how it works. It really does work this easily. So now I want to introduce you to the 90-year cycle. This is really what we're all about this year. And it's a very strong cycle in commodities as well. And more importantly, if we take the 1929 crash and we added 90 years, that took us to 2019. And, we got the high just 6 weeks into 2020. So when you got to factor a bit of a tolerance on these yearly cycles.
Right.
That's why we've been writing 0 hour. We were talking about a big crash coming in. And it wasn't just the 90-year cycle. We already looked at this chart. I showed this one to you. But we got to go back another 90 years to 1839. And 1837 to 1842 saw what was known as the Long Depression. And this was because money was really cheap heading up here into 1837. And there was a lot of speculation around Chicago and the Great Lakes. Land prices were very cheap, and they were building canals like crazy to get the agricultural products out into the Great Lakes and then up the St. Lawrence Seaway and getting them out internationally. So, you know, credit was cheap, and we got this massive boom, and we went to bust, you know. So what we're seeing is we're getting 2 90-year cycles or 180-year cycle. And that's why I was getting concerned. I said this, you know, you talked about 0 Hour that I wrote with my friend Harry Dent. I was showing him this stuff back in 2008. And, you know, the more we worked on it, the more we realized we had to collaborate on this. So we've got this cycle.
Andy, just bringing up cheap credit back there in that time zone, I believe the credit is as cheap now as it was back then. So, I mean, we're talking about 200 years rates. It's been almost 200 years since credit has been this cheap. Is that correct?
I would have to look that up to be absolutely correct, but I am absolutely sure you are right, Dale. There is no doubt about that. Yeah.
Okay.
I mean,
and then the repercussions from that.
Yeah.
Okay.
We'll look at, actually, I think coming up next, we'll look at those as well. So let's just.
I was only a kid then.
So yeah, you and me both, buddy.
Yeah.
So, but the halfway cycle then is the 45-year cycle, and we take 1839 because it's the precise point, and you know we look at 1884, and in 1884 we got this pullback here. It wasn't a huge pullback, but it was still 20-30%, I believe, and that really was all to do with gold, and Britain had a gold crisis going on there, and they were coming on and off the pounders. They were messing around with the gold standard, and a bunch of gold went missing. I think some ships sunk as well. But here's the cool bit. Let's take 1929 and add 45 years. And you get the Middle Eastern oil crisis, the OPEC oil crisis, right?
Yeah.
We had a huge recession. Now, you and I were definitely there, and I remember it very clearly here in Britain. You know, we went on to a 3-day week. We had power cuts, power outages. And, you know, we had no power at night and so on.
Win buttons, whip inflation now.
Yeah, absolutely. And you can see this is a logarithmic chart here. You can see the magnitude of the 29 crash, though. And when we look at this logarithmically, it's like just a blip, isn't it?
Yeah.
But this was a major point, an inflection point. And we move on 45 years. We get this big sort of crash we got February, March. And what do we get in March? Oil crisis.
Yeah.
Regular as clockwork, this stuff. So
I never thought I'd see a negative number on a futures contract.
Oh, that was crazy, wasn't it? Yeah, I was kind of like, how do we manage the risk of this?
That was the one, you know, first time in my lifetime.
Yeah, that was just crazy. I mean, I was just watching the screens, and we just kept well clear. I mean, it was kind of like, this has got to be a no-brainer. Let's do it. But hey, we don't want to be caught on the wrong side of this if we're wrong, if we miss something. So we just kept well clear that day. So now we talked about credit cycles. Let's look at the 100-year cycle. And folks, this is the home run, as it were. This is the last bit of this. So, you know, you can get ready and we'll look at things in a bit more detail. Well, the 100-year cycle, back in 2008, I was over in South Beach. Actually, this is where I first met Harry. I was also with, there were 40 of us, and there were some big names. And for some reason, I was there. I just minimal knowledge in cycles, but Jim Rogers was there, Bob Proctor was there, Tony Robbins was there, a few people, and they were throwing ideas around saying nobody could have predicted this. And I quietly said to one of the guys, well, you know, the 2007, we're 100 years on from the rich man's panic, right? And you mentioned credit, crises. That's exactly what happened. 1907 was caused by it was called the Knickerbocker crisis. In fact, we'll look at the charts in a minute. So I won't run too far ahead. And then you take the half points of these and you get 1857. So do you see how this is coming in the 150-year cycle as well as it was in the 72-year cycle? So
so you look for the confluence of a lot of cycles all pointing towards one time zone.
And that's what those histograms are. They're confluence cycles. Yeah. Okay.
Mm-hmm.
And so 1907, we'll talk about these in a minute, 1957, 2007. So, you know, 2057 is going to be another one. You know, as I said, the confluence in 1857 is important. But back in 2006, I was over in Cincinnati talking to a private client group, and they said, look, this is coming up. You might just want to protect your wealth. And there were runs on banks in all these cases, and they were going, that can't happen. We're in the modern age. We're in the 2000s, dude.
Yeah.
Well, in England, we had people in a line outside the Northern Rock Bank trying to get the money out, and that bank folded, and several banks folded globally. So let's just dig in a bit more detail. So this is the 2007 global financial crisis, and the market came down, as you know, just over 50%, 54%. And 1907, this was the rich man's panic, the Knickerbocker crisis. The markets actually came down 80%, and it was due to the rapid withdrawal of credit. And, the government brought in JP Morgan personally to help bail this out. And what happened in 2007, we definitely heard the name JP Morgan quite a bit, didn't we?
Yes.
So, yeah. But here's the thing. Here's the trick. Very few people know that in 1807, the American market collapsed 80%. Why? Because America was trying to influence the Napoleonic Wars in Europe. And they figured that if America stopped all trade with Europe and England, it would bring the European economies to a halt. Well, in theory, that was probably going to work, but it wasn't. It didn't bring them to a halt before it brought the American economy to a halt. So
interesting. So this was the first example in American history of trade policies like embargoes and tariffs creating a disaster.
You know what? I think it could well be. Yeah, I never thought of it like that.
Okay.
Dale, that's a very cool point, because I've done.
It's like we, started this as well last year.
Yeah.
It rhymes. It's not an embargo act, but trade friction anyway.
Trade friction and trade wars. It's all part of the same thing. And we've follows my report. I do write about the cycles on this, and probably outside the scope of this, but the Hong Kong cycles came in with China has very many cycles coming together. That's why you've seen it in the news last year. Last year was 30 years on from Tiananmen Square and 60 years on from the Tibetan uprising, as well as 120. So you get 120, 60, and 30 all coming together. That's why China was in the spotlight and is in the spotlight. They were all international relations issues in every one of those. So but that's a little bit outside the scope of what I prepared. I mean, if you guys like this, just another shout. And but let's just go into the 50-year points of this. And I want to show you that 1957 had a recession and a big pullback. 57, it wasn't a crash per se. So this is the 50-year cycle. 1907 plus 50, gave us this. If you go back to 1807, add 50, you get 1857 that we've talked about both in the 72-year cycle and this cycle. But 1957 saw this pullback because basically everybody that could afford a refrigerator now had one. Everybody that could afford a television now had one. Everybody that could afford an automobile now had one. And so manufacturing just ran out of steam. That's basically what it was. It was saturation, as it were.
Okay.
And here's the 1957 chart. It's only down 20%, but it's sufficiently, over a year. It's a reasonable move,
Yes.
1857, I just wanted to recap this one. This boom and bust was because it was all to do with railroad bonds. Railroad was it was as developed as it was going to be for that time period. And over in Cincinnati, the Ohio Life Insurance and Trust failed, creating the Knickerbocker. This was just the big crisis then. And this was the biggest banking failure in American history to date. And it was greater than what happened in the global financial crisis. Over half the banks in America went bankrupt in 1857. So you can see now these patterns are repeating very clearly. And just, in case anybody else is a non-believer, this one just freaked me out. I have to say I wasn't seriously trading in 87, but I do remember the 87 crash. And basically what we saw there was this. The highs came in the same week. So these are 50 years apart, these two patterns. We get we see the high there, we see the low to the day, we see a similar pattern. So no, nothing's perfect. You use the phrase rhyming, and that's really what we see. There's often clues to get the odds on our side. So let me this first part of the presentation now, and I'll zoom in, but the reason we're in such a critical point right now is that, we're 90 years on from the 29 crash. That's 2019. So we've overlapped in. It's 45 years on from the 74 low and the oil crisis. Now, this is, I didn't mention this, but 2019 saw a big oil panic, and that went into 2020. What did we see? Like you talked about negative oil prices for, front month delivery. 2020 is also, so not, if you look at the 1929 crash, it came down in bits, and there was a big acceleration. There was a collapse in 1930. We talked about the 300-year cycles from the Mississippi land crisis and the South Sea bubble. Now, these two are really interesting. But 1819 to 1820 saw land panics, as did 1920. Well, what are we seeing? We're not so much seeing a land panic right now, but we're seeing people moving out of commercial real estate. And here we are on Zoom, everybody's doing stuff on Zoom. Also, we're 72 years on from the Middle East, the creation of Israel, which created a bit of geopolitical friction, and 144 years on from Britain and Egypt having a crisis. So I think we are going into some war cycles soon, and that's something that I've written about recently. Again, outside the scope of today. So the real challenge we face is that, from history, we can see some very clear cycles, but, do you ever have a stop that's a year wide, in time, let alone price? No. So you get in too early, the account runs out. Get in too late, you miss the boat. And so this is very important to whether your business and financial investments are going to be successful. So what we did was we created the system of these histograms, which I've already, alluded to. And these are all cycle sets. And you mentioned confluence, and that's exactly where we get cycle confluences. And where they peak in the future, you can see that there's a potential for a change in trend. And let me give you this example. This is just going back 2014, just to illustrate the point. This was the biggest spike we ever saw. This was all in real time. These are predictive. These are there before the market unfolds, as it were. These were existing here, but we didn't have this bit of the market. But this spike alerted us to something big happening. And of course, we've been in this sort of uptrend on the euro for over a year. So this is kind of getting quite exciting. And you could argue that, there's a bit of trend line resistance coming in. But the monthly cycle was giving us a huge warning. And then we looked at the weekly cycles, and around about the same time, we're seeing a huge spike in the weekly cycles as well. And then you can see how the monthly cycle and weekly cycles are pretty close together. So this puts us on long-term alert, or, over a window of a few weeks. And then we're looking for something, ideally, if they all lined up together, which they very rarely do, but you get, a real gift. So we were looking for something big to happen. And we found a daily cycle here. And as it happened, that then turned out to be the day of the high.
Yeah.
And, you can see here, this here ties up with this low and so on. So I'm just trying to illustrate our system, and we'll look at some of the topical stuff coming up in a minute. Same thing on crude oil monthly cycles back 2007, 2008, 2007, wasn't it? Yeah, that's right. With these here. And the same again here, you can see these things. These are older charts. I just use older charts because otherwise people want to focus on what's happening now. And we'll talk about that in a minute. In fact, let's talk about it right now. We mentioned these, so you're probably getting the hang of these now. And, you might want to make a note of these or whatever. But this is just some pretty clear points that are already showing up that we've marked down in our diaries. So what do? We use these to protect trending positions. We don't immediately take the reverse position because we've got to be able to quantify the risk. But late October 2020, I'm seeing that as a significant point. Then mid-January 2021 and late November 2021. Taking this a bit further, if I just tell you a little bit about the market timing report, is that okay with you, Dale? I'm just going to,
Sure.
Yeah. So, this is what we show to people. The benefits are really that, look, you guys are all, pretty much professional traders, but this is about taking everything into your own hands and being responsible. So, having timing helps make, your decision-making process and, rather than taking tips from your broker. And what we do in the report is it's a monthly publication where we cover the S&P 500, gold, crude, dollar index, euro, and I've added Bitcoin just using the GBTC, the proxy. And on the cover, I put up either 1 or 2 dates, which I believe to be the most important dates of the month, and they will usually apply to the S&P. And we started this back in 2014. You know, we were using this, we developed this system in the early 2000s, and we were trading it ourselves very happily, and also working with a handful of hedge funds and just selling them this information. And then people kept saying, hey, we want to access this. So that's why we created the report. And these are the arrows are the turning points we called on the cover, and the little ones are the smaller cycles we called inside. So we're not perfect, but we've got pretty much most. I mean, we probably missed that high there, but we've called pretty much every other one since then. And I like putting a lot of geopolitical commentary in because it just gets interesting for people. And also, you know, we can get an idea of what's happening in the world and so on. Once we get into each individual section on the market, we have a red section, which basically shows you the longer term cycle. So this is like the weekly cycles that I showed you. Mm-hmm. And if you're an investor rather than a trader, so you're a portfolio manager or whatever, these are the key dates you need to look at. And you can ignore the rest of it. But also I like looking at decennial patterns. You saw the 10-year patterns, and I'm going to show you a very interesting one on the dollar index in a minute. But basically, we look for matches, and we quite often see pattern matches between the 10, 20, and 30-year cycles going back. Also, in our system that we've created, we find that there are certain days in certain markets. Here is crude oil. I mean, look at this, 28th and 29th of September since 1984. They have very high probability up days on the 28th and 29th of September. So, you know, if we're running up into that, it's probably going to go up through those days if we don't get any other indications. And that just gives us a little bit of a tailwind. You know, you can't trade on it alone. And of course, the most important thing is our proprietary profit finding histograms, as we call them. And these are the turning point dates. So we give the daily dates there, the weekly and the monthly ones are in the red. Also, I look at a lot of seasonality. So if we can see, you know, for example, gold tends to make a low around about the 14th of September over the last 30 years and a high around about the 28th. So that's regular seasonality. But if we got one of our timing dates here and we're making a low, say on the 10th over the timing date, we might want to get in a few days earlier. You know, equally, if there isn't a timing date, we might not be seeing that working this year. So it just, again, gets the odds on our side. None of this is pure information by itself. And of course, you know, with Fibonacci levels, if it's hitting a price level, then, and there's no time cycle, it'll probably go to the next Fibonacci level and vice versa. But just to show you, this example was just showing some people last year. I just kept it in here. You know, gold was running down last May, and we had a very important weekly cycle as well as a bunch of daily cycles. And we got the breakout. You know, at this time, everybody was very bearish on gold. You know, they were saying it was going right down to 1,000. But we had these strong cycles, and that's where we got the breakout. So we managed to get in there, and that worked pretty well using this. And also, some of our followers they didn't have a trading system once we, you know, started marketing it as a retail product. So we've created a trading course, and we show people how to use, you know, different systems and, you know, our particular nuances. And basically, when they tie up with us with a time cycle, you know, it's a time to potentially take profit. And when they don't, so, you know, why not this cycle or this cycle? And that's kind of how we use that.
How do you manage risk, Andrew? Because these are based upon time rather than price. Do you just use some type of monetary money stop, 1%, 2% risk, or do you have to give it 2 days either side of the dates?
No.
So I'm curious how you manage risk on these.
I tell you what, hold me to that one, and I'll show you a great example just later on the deck. Yeah. Okay. And yeah, because that's really important. You can't trade off time alone. Well, you can, but your account might run down.
Yeah.
So, and in fact, this here is one. I use a lot of Andrew's pitchforks for managing risk, and we've put this in our course, and we have a particular way of using them. But so what we will do is, you know, for example, here, this is a profit target. I know, and I've watched your show. People use pitchforks. So you'd come out here, but we got a retest here. And, you know, basically that retest, we would then have a downsloper in or, you know, some other parameter to take that short trade. And we had a clear time cycle coming up. This is an older example, but this is an example of traded both up and down. And what we did here was we had the Fibonacci level at the median line, so we knew we could get back in. And I'll show you how we use these pitchforks in a moment to manage risk. But yeah, that is absolutely critical. And so, what we're saying is with the market timing, it shows us when to get in and, gets the odds on our side. Again, doubling of ranges with gold. We tend to be position traders, and, we do manage a professional portfolio. And we'll look for the bigger patterns. This is a great example of just doubling of the range, giving us the high. But, like Crocodile Dundee says, you can live on it. But this is even better. This pitchfork going back 45 years gave us the exact high there. And in fact, you asked about managing the risk. What we'll do is we'll put a pitchfork in here. And once the trend is confirmed, we'll then put a risk reward ratio based on, this is too big in this case, because this is a weekly chart running 45 years. But once we've established a target using some other techniques, we calculate the risk reward ratio and then put the stop in. But as you guys all know, there is only one thing you trade, and that's price. Time is helpful, but it's only price that makes you money. Here we had some very big cycles in April on gold, big monthly cycles, and we haven't taken the April highs out. And again, that's that same pitchfork, and we put some action reaction lines in, and that's why we're still fighting this out. We came all the way back to the top of this line on Friday when we got the big sell-off in gold. So we're still fighting this line. If we sit here, we might head back on up, but there was some strong cycles, and the commitment of traders data was pretty bearish till recently on gold. And then we kind of put in an overview of the daily turning points. And the beauty of this grid is, if you see everything coming together on the same set of days, there's going to be some big economic news. Here we're just seeing, like just crude oil on the 27th of September. This is a couple of years ago, I think. But where you see all these things together, that's a big economic story breaking.
Like, do you have cycles for this Wednesday with the Fed? A lot of dots, different confluence of markets.
Yeah, actually, we'll do that in a second, actually. Yeah, okay. So that's, yeah. So what we say is, you can use this with fundamentals and exactly what you just said there, protecting your trending positions, Fibonacci levels, pitchforks, and cut data. And let me, I got a few more minutes to run through this. Basically, we use this for our fund management, and it gives you additional tools. I've spoken about, sorry, this is part of a presentation that we give to other people as well. I'm not here to sell you stuff, but what we did was, I was working with a very well-known US billionaire who is mad on cycles. We have an NDA. I can't tell you who he is, but he's very successful. You'll have pretty much all have heard of him. And basically, that's why we created this report. And then people didn't know how to use the time cycle, so we created a trading course. And the idea with the trading course is really what we've been talking about, how to protect risk and calculate objectives and how to use timing with it. So I'm just going to run through that because I want to get to some better stuff. So what we do is we use this together with seasonality and COT reports, which we just call the timing system. The smart money system. And, for example, right now, for the Aussie dollar, May's generally pretty bullish. I know we've got a big run up, but take a look. I want you to take a look at this. The Aussie dollar seasonally since 1988 tends to make highs round about the end of the first week, then sell off. Let's just bear that in mind, exactly about what you talked about coming up next few days. So that's the first point I want you to look at there. We also have a weighted average there that we have a little proprietary thing there that gives us a bit of an advantage. I'm going to gloss over that slide. But I don't know if you guys tend to use the commitment of traders data very much?
Yeah, many look at it, yes.
Yeah. So what we find here is just a quick overview. The commercials are the people, they're the hedgers, the people that drive it. And when they get to extremes, the market, this is our platform we've created. And they tend to sell in uptrends because they're producers, as it were. So, here the red line shows the commercial selling as the market goes up, and they get to this extreme high line that we have. And, basically that's where the market makes a high. But what we have is created our own index, and that can flatline, and we don't know when something's going to change. It can flatline for a long time, for a couple of years or whatever. This market went sideways. But what we then found was that if we applied our timing cycles, we knew that would be the week to look there. And of course, sure enough, that was the time to look, and that was the time to look for getting short. So we would look to manage our risk on the short side there as the market came on down, you see. So that's how we use these timing cycles in there. And what we do is we put all the data, we just download it from the CFTC, and this gives us ideas of what areas are changing and so on. And we look for real extremes. This one's just a few weeks old, but you know, we were seeing extremes in palladium there, and they highlight in color, you know, if they're below 5% or above 95%. And these are markets that we'll zoom into then. So I just wanted to share that. That's one of the things we combined with this. And now we put, well, yeah, we put our track record there up on the website as well, so everybody can see it, whether we're right or wrong. Now, this is what I want to share with you, and I'm going to run up to the dollar index. But here's some long-term cycles. Here's the monthly cycles on copper. And we see this huge spike all the way here in September 2021. So I'm starting to think maybe this could be the beginning, you know, that we might run down. I know copper's been all over the place the last week or two, but we might run down and see a sort of end of recession type low around about September 2021. But in any event, whichever way copper's moving into that, it's more than likely going to reverse. So that's that. Gold, a couple of longer term turning points, and I'm going to show you a shorter term one. Late August to beginning of September 2020, we're seeing a turn, and also mid-February 2021. So again, these are these spikes that are predictive. But here's a very strong cycle that I've just put in the latest report. The week ending 24th of July, look, take a look at this. This is a big spike. We got that high on the spike there, that big high that got us a low, and we got just the beginning of a trend there. So not only have we got the daily cycle, the weekly cycles for the week ending 24th July, we also have daily cycles on the 21st to 22nd July. We'll fine tune them as we get into the beginning of July. So I think there's going to be a very big inflection there. Is it going to be a high? Is it going to be a low? I don't know. I don't know. What I would do is that if I haven't, I mean, we don't have just, you know, no positions in gold right now. It's just too volatile. But I would be certainly protecting my position in that if I did have one. Dollar index, February 2021. So, you know, we're seeing some interesting things. You know, here we go. Gold, February 2021. Dollar index, you know, February 2021. So there's something big cooking for next February already. So that's that one. And right now, this is what I show you. We have a very big spike for the dollar index this week ending 12th June. Again, same deal. You can see the reversals on previous spikes. You know, it's not perfect. Sometimes we miss them. You can argue that was a correct call. And they don't get them all. We have to run more than one set to catch them. But first point, warning, this week there is a big cycle. Now, look at this. The decennial patterns go back 20 years. That was the 7th of June. So that was the equivalent of yesterday being a Sunday. That's today. We started seeing a change in trend. We've been coming down basically the last few days on the dollar index. And I saw Steve talking about that. But look at this. From here, we start trending up. Okay. Now, I don't know if we're going to follow the same thing, but let's just flip back 10 years and 30 years. And look at this. The 10-year cycle made an exact high there, 7th, 8th June. And the 30-year cycle starts a big decline. And these guys then maintain this pattern all the way into August, right? Yeah. So, and go back to this one, this maintains this pattern all the way up into September. This suggests that whatever happens in the next couple of days, we're going to see a trend developing that might well run for a few weeks.
From your lips, amen to having a trend in the dollar. That would be good news for all of us Forex traders. So thank you on that, Andy.
Me too. Me too. I would love to see a trend. And this is the setup right now. This is the sort of the cash rally. The futures pattern is slightly different on the June dollar index. But this is the pitchfork we were using. And this, once we got a rejection of here, we actually got this one here. We went short there because we could protect the risk off this. We use so you're asking about how we manage the risk. Yeah, we don't trade on time. We got to have somewhere to put a stop, a hard stop, together with a target and a risk reward ratio. But you see, right now we're off the 786 retracement on the daily chart, and this is going to be. If I'd have loved to have seen it come down to here. If it come down to here, made a double bottom right on the median line, that would be a gift because we could then put the opposite pitchfork in and point upwards. But I think we are on high alert. We're on red alert now. If you've got a position in the dollar index, if it's more than just an intraday position, if you've been position trading it, then you probably want to protect that. And I think there's some big changes afoot this week. And I think once it shakes out, we're going to head into a trend.
Thank you for sharing a timely cycle, Andy. Thanks very much.
I know you guys are shorter term. I've just never been on before. I wanted to give
I try and be patient, but sometimes I can't wait for 100-year cycles.
I know it's tricky, isn't it?
Because,
just pop out to the diner and you miss it as well. That's the crazy thing.
I think Rip Van Winkle could trade those. He just goes to sleep for a little while. So I really appreciate the work.
Right.
And we're getting some excellent feedback for you, Andy. You're going to have probably some new subscribers, at least some new followers. We should follow this guy, Edith said. I hope he's on Twitter. Then someone shared your Twitter.
Yeah, we're on Twitter. Yeah, sorry.
You have a sympathetic smile. That's because you know how hard it is to trade. There was a guess that billionaire was Ray Dalio. And thank you, everyone. Everyone's appreciative of your presentation. And like it or not, Andy, you're now my trading warrior brother.
I love that. I'm going to put on Stairway to Heaven soon as
All right, Andy, really, I'm glad that we finally were able to do this. I'd like to keep in touch with you. I'll DM you later and we'll get another date for you. I want to wish you and your subscribers and all the people you teach that pips rain down from heaven on you guys on your key dates, and really was great having a conversation. Thanks for edifying our community today.
Dale, thank you so much for having me on your show. It's been my pleasure. I'm very honored, and if you like it, I look forward to seeing you all again soon, guys. And I'm on Twitter there, Andrew Pancioli, and come sign up at markettimingreport.com. There's a bunch of free stuff there as well. Okay.
Thank you, Andy. Everyone, Andy Pancioli, and that's a wrap for us. We'll see everyone for Turnaround Tuesday. Remember, whether it's cycles or anything else, don't just count your pips, count your blessings. Adios. See everyone tomorrow.